In this video, I'm going to discuss the different inventory cost flow methods that are available to companies under US GAAP. And the reason we need to, as a company, we need to choose a cost flow method is because companies are buying inventory at different points in time and also at different prices. And when you think about it, if you're buying inventory at different prices, later on when you sell those items, then you got to determine what is your cost of goods sold going to be. Is it based on the newer prices, the older prices? And that's what we're going to talk about. So here's a quick little illustration of some possible transactions that a company has. So imagine a company on May 1st buys 2 units at $3 for a total cost of $6. That gives them an ending inventory at that moment of $6. If they later buy 3 more units at $3.25, that's $9.75, then their ending inventory is going to be composed of the original 6 plus the $9.75 over here. So that's $15.75. And then on the next transaction, you sell 2 of these units, 2 of these 5 units at $6 each. So then the question comes up, at what cost do we expense them? Do we expense those at $3.25, or do we expense them at $3, or the average? And those are the methods that we have available to us right here. Okay, so using this information about inventory transactions, I'm going to illustrate how we account for inventory under these 4 methods here, which is specific ID, average cost, FIFO, which is first in, first out, and then last in, first out for LIFO. I'm also going to illustrate the difference between having a perpetual inventory system and a periodic inventory system as I illustrate this. Okay, so let's begin with the first method here. Under the first method, this is referred to as the specific ID method, and not very commonly used unless you have small quantity of inventory, or if you have big ticket items. Maybe for those kind of things, you specifically identify the asset that you sell, and then you cost out that specific asset. So very widely used for custom type builds. If you're making something that is custom, obviously you incur those costs, you quantify those costs, and then that's going to be your cost of goods sold for that specific item. So this one's fairly straightforward in terms of how you account for it. Now, most companies that are moving larger volumes of inventory will either use the average cost, FIFO, or LIFO. So let's start out with the average cost. Under the average cost, you're really doing a weighted average, not just any regular average, but a weighted average, because the more units you have at a particular price or cost, the more that influences the average that you're looking at. So let me give you an example here. If you recall, we have $15.75 of inventory. Well, that's made up of 2 units at $3 and 3 units at $3.25. When I get an average cost per unit, I'm going to take the $15.75 and I'm going to divide it by a total of 5 units. And I know it's 5 units because I purchased 2 over here and 3 units. So far we have a total of 5 units for an amount of $15.75, and that gives us an average cost per unit of $3.15. And it's weighted because these right here, since there's a higher frequency, they're going to influence the average upward more than these right here. Because you notice that it's $3.15, it's closer to $3.25 than to $3. That's what the weighted average effect will do. Now, using this information for the next transaction where we sell 2 units, if I am using the perpetual, which is a moving average, okay, I have to compute an average every time I buy new merchandise. If I'm using the perpetual inventory system, then I would have a cost of goods sold, which would be $3.15 per unit times the number of units sold, which is 2. So this will be times 2, which gives me 630. That would be my cost of goods sold for this particular transaction sold at $2. So when I do the computation for the ending inventory, I have 1575 minus now what I'm taking out, which is 630. And that gives us $9.45. Later on, when I buy more merchandise, 5 units at 330, that's going to add to my total here. So I'm going to have 945 plus 1650 for that new purchase. And now I need to do a new average. And that's what this means by moving average. Every time I have a new purchase at different prices, or even at the same prices, I have to redo the average. So now this is going to be $25.95 divided by, there were 5 units here, but we sold 2, so there's 3 left. So 3 plus 5 is 8, divided by 8 units. And that gives me a new average cost of $324. And this new average is what I use going forward for future sales. Okay? Now, just to refresh here, I divided by 8 because now the ending inventory is made up of these 5 plus 3 out of these 5 from before. 3 because I sold 2 here. All right? So on this next transaction where I sell 6, the cost of goods sold is going to be the new average cost per unit based on a moving average times 6 units that I sell. And that's 1946. My ending inventory will now be whatever it was before minus what I cost out here, which is 649. Now, look at what we have here. This value right here, the 649, is going to be our ending inventory on the balance sheet. And then the summation of these right here is going to be our cost of goods sold for the month ending 5/31. So this information here is used for us to be able to come up with the inventory value on the balance sheet, which is $6.49. That's what's left over. And we'll also use that to compute the cost of goods sold for the period. Okay, so the gray here corresponds to this gray, and then the yellow. So let me sum up this right here first. Bear with me here. Okay, that's okay, so our cost of goods sold for the period is going to be $25.76, and that's what would go right here. The revenue is we sold in total 2 units at 6, that's 12, and 6 units at 6, that's 36. So the revenue would be 48. That's right here. So then this would give us a gross profit of the difference of 48 minus 25.76. Now that's using perpetual average costing. Now let's look at how this would change if we were using the periodic average, okay? The periodic inventory system under average costing. And whenever you use the periodic inventory system, instead of updating the books continuously like we did right here, we would do an analysis only on a periodic basis. Now, it's real important that you identify what that period is for analysis. So if I say that I analyze the inventory at the end of the month, then the period that I'm choosing for the periodic inventory system is monthly. And you know, at the most extreme level, you could say that the perpetual inventory system is sort of like a periodic inventory system for which the period is a day or an hour. In other words, we're constantly updating the books on a really small period of time, right? Now, instead of calling it periodic with a small period of time, we just call it perpetual inventory system if we're constantly updating the books. Whereas under a periodic inventory system, we wait until the end of the month, in this case, to update the books. So look how this would change here. So let me erase all this here. If we were using the periodic inventory system monthly, we would take the total of the purchases, which is these right here, which is $32, and I would compute an average for the whole month, not a moving average, but instead a monthly average that I do at the end of the period. Okay, so that'll give us a different result. So if I do that, my average cost is going to be, let me do a column here where we say average cost. It's going to be equal to the 32 here, that's the summation of all the purchases, divided by all the units I purchased. So I purchased 2 here, 3, and 5, that's a total of 10 units. So when I divide it by 10, I'm analyzing it for the whole month. And the average for the whole month is 323. I would say that my cost of goods sold for that period is going to be this times the units, the number of units I sold. So the number of units I sold was 2 here and 8 here. Notice how I'm using the whole month as my analysis. I'm not updating the books every time there's a transaction. No, for periodic, monthly periodic, I'm just looking at the whole data for the month and saying, listen, I sold a total of 8 units, so I need to cost 8 units at that average. And that's $25.80. So if we were doing the average cost system using the periodic inventory method, we would have cost of goods sold be $25.80. And then our revenue stays the same, $48. And then our ending inventory would be the difference between what we had available minus what we took out as cost of goods sold. So our ending inventory is going to be the total of 32 minus what we took to cost of goods sold, and that's 645. Okay, so notice how this is a fairly straightforward example, but nevertheless you can appreciate how the difference between perpetual and periodic can give us a different gross profit here, right? This is going to give us, let's go ahead and do this one here. Well, let me do the formula down here. I'm sorry, I didn't do the cells so that it would be easy for us. This will give us a gross profit of $22.24, whereas here we're going to have a gross profit that is $22.20. Okay, now this is a small amount, these are pennies that we're talking about, but nevertheless the approach you take can have an influence on your profitability, can have an influence on the balance sheet item inventory as well, right? Okay, moving on to the next item. Let's go ahead and erase some of this stuff here. If we use the first in, first out, and we use the perpetual inventory system, you're going to see that ultimately it's going to be the same as the periodic inventory system. Okay, so this is the only one where whether you use perpetual or periodic, you're going to get the same information here. Now let's go ahead and work on this here. So if I am, let's start with perpetual. If I am using the perpetual inventory system, I'm going to go line by line trying to figure out what my cost of goods sold is. So we determined that ending inventory here was 6, that here was 6 plus the new purchases. And then now I sold 2 at $6 each, I sold them. So what am I going to cost these out at? Well, if I'm using first in, first out, I need to cost it at the first in right here, which is at $3. So that's going to give me a cost of goods sold of 2 units at $3 each at this cost, and that's $6. And then what that means is that my ending inventory is going to be made up of these units right here, 3 at 325, and that's 975. Now, the next item that occurs is that you have a purchase at 330 each. So my ending inventory now is going to be made up of 975 plus the new units. And we come across the same issue again. If I sell 6 here, how am I going to cost them out? Well, this layer still has 3 units, so you're going to have to cost out these first in at 325. So 3 at 325, and then the remaining 3 are going to be at 330. That's your cost of goods sold. So you're working yourself up from the first in to the first out. All right, and these are already gone because you sold these already. You costed these out already when we did this cost of goods sold right here. So let's go ahead and do the math. This is going to be 3 units at this price, at this cost, plus we have to also include another 3 more, 3 at 330. Okay, and that will give me a cost of goods sold of 1965. And then my ending inventory is going to be made up of 2 of these. Okay, that's what's left over. 2 at 330, and that's 660. So the cost of goods sold here, 2565. Revenue is 48 because we're keeping the sales price constant. And the gross profit is going to be 48 minus 2565. Gross profit here is 2235. And what you'll find, and I'll do it very quickly here, is that we're going to get the same values for the periodic inventory system here. So let's go ahead and do it. So, for example, the number of units that I sold during the period. Again, we have a total inventory of $32 that's available for sale, right? These are our goods available for sale. And now the question is, how do I cost these 2 and 6? So technically, I gotta get cost of goods sold for 8 items. Well, the way you're gonna do it is, the cost of goods sold is going to be as follows. You're gonna get 2 at, or let's multiply it, 2 times $3, that's these right here, those are the first in, and that still leaves us 6 more to account for. Then, for the whole period, you're going to go in there and get the next layer, which is 3, you're going to get 3 units at 325. And then you still have 3 more units to account for because you sold 8 in total. So that's 2 here, 3 here, we need 3 more. And that's going to be 3 at 330. And when you do this computation, you will find that you're also going to get $25.65. Now, ending inventory is going to be made up of what remains out of these. So you took out 3 out of here, so you have 2 left. So that's going to be 2 at $3.30, which is $6.60. So notice how that works out the same as to over here. My apologies, there's some lightning going on outside. Pretty intense. So here's 2565, and then inventory 660. Same as for the perpetual inventory system. So either way, whether you do perpetual or periodic for FIFO, it's going to be the same. Okay, you'll get the same gross profit. Now, what'll differ is when you use LIFO, those two will differ. And we're going to go ahead and do that right now so you can see. So I'm going to erase this so we can start again. There we go. Okay, so if we're using the last in, first out, then that's the complete opposite of this, right? So, before I go there, I do want to mention something. Whenever you use a cost flow method like FIFO or LIFO, for example, let's look at FIFO. What this is saying is that your first in are your first out to cost of goods sold. So in other words, your cost of goods sold is going to be based on old prices, the first things you bought. But the opposite is true for ending inventory. Your ending inventory is going to be based, in other words, your asset is going to be based on current prices. Notice how at the end, and I just erased it unfortunately, but at the end, this was made up of 2 units at 330. Those were the most current prices, right? And that's what I mean by ending inventory is at current values. Maybe I can undo this real quick so you can see. Here we go. So if you recall, when I did the ending inventory right here, this was made up of 2 units at the most current prices. And that's what I mean right here. Now, when you jump over to LIFO, that's going to be the opposite. Ending inventory is now going to be based on the older prices, like the 3. And then cost of goods sold is going to be based on the more current prices. So let's go ahead and see how that works. So if I'm using LIFO perpetual, okay, LIFO perpetual, then I start out the same way. I have 1575 as my ending inventory. But now when I sell these 2 units, I'm going to cost them out at the last in, which is 325. The last in on this particular, based on this date, because we're doing perpetual. So cost of goods sold is going to be 2 units times 325, the last in. And then my ending inventory is going to be the difference there. You can either do the difference or you can compute the actual units themselves, like 2 at 3 plus 1 at 325. It should work out the same. Then when I purchase 5 more units, that's 1650. My ending inventory is going to be this plus 1650. So then the question comes up again. If I sell 6, where are these coming out of? Well, we're using last in, first out. So these are now the last in on my analysis on May 25th. So I'm going to cost 5 at 330. And then the last one, I'm going to cost it out from the 325 layer. Recall that when I sold 2, I took out 2 out of here, right? So I still have 1 left over at 325. That's what I'm going to use over here. So my cost of goods sold is going to be 5 at 330 plus 1 at 325. Okay? And that's 1975. What I have left in ending inventory, I can, I'm going to do the math like this, but I'm going to also explain it to you. What I have left over in ending inventory are basically these 2 units on the old prices. So that's what I mean over here by ending inventory is going to be based on your old prices, while cost of goods sold is going to be based on your more recent prices, your more current prices. So let's go ahead and put this over here. That's $48. And cost of goods sold is $26.25 based on this analysis. So my cost of goods sold is the difference. Okay. Now, if I use the periodic inventory system, things are not going to be the same because of the fact that I'm going to analyze the whole month at once. So let's look at how that would look. Cost of goods sold would be made up of 8 units because I sold 8 units for the whole month. So I'm doing the analysis at the end of the month. But I'm going to have to start consuming these 5 and 3. By the way, I just noticed that the way I I set up this problem right here is going to end up giving us the same amount just by chance. But normally these are not going to be the same. They'll work out the same if it just happens to be, in this particular case, the way I set it up. So cost of goods sold is going to be made up of, if I sold 6, if I sold 8, it's going to be made up of 5 from here and 3 from here. And that's going to give us the same amount, unfortunately. But nevertheless, what I want you to understand is that sometimes that's not going to be the case, all right? 5 at 330 plus, so we need to account for 8 that were sold. So far I have 5, and now I need 3 of these. So that's going to be 3 at 325, and that will give us 2625, which is the same as this 2625 when we use the perpetual inventory system. Unfortunately, that's the way it worked out. Okay, so that's 2625. This is 48. And my gross profit is going to be the same. My ending inventory is going to be $6 as well. And there we go. Okay, so to recap, when you do FIFO, you will get the same amounts independent of whether you use perpetual or periodic. But when you use LIFO, you may end up with different amounts using the perpetual versus the periodic. By coincidence, it ended up being the same for me here, but keep in mind that it can be different. Okay. Now that illustrates the four more common methods. There is another method called dollar value LIFO, and dollar value LIFO is a little bit different in the sense that we do not track quantities. Instead of focusing on quantities like we were focusing on right here, every time we would purchase, we would be analyzing the number of units and then the dollars that correspond to those units. Instead of doing that, under dollar value LIFO, we focus on the bulk amount of the dollars instead of the units themselves. And I'll have a separate video where I illustrate how we do this, but let me give you a little background as to why we have this method. Okay, when you use LIFO or traditional LIFO, let's call it. Okay, when you use traditional LIFO, you end up with some issues that may not be desirable, and one of those is related to LIFO liquidation. Okay, LIFO liquidation issues. What this is, or how this occurs is, if I'm so sorry, this rain outside is bad. How this occurs is as follows. Notice how my inventory of $6 here is made up of 2 units at $3 from a price that is long ago, from the old prices, right? As more time passes, it might end up being that we keep this in inventory continuously because we keep buying more inventory. So we expense the last ones in, but never expense the first one in because we're using LIFO, right? So sometimes when you use LIFO, you get to a point where once you start liquidating an inventory item, in other words, you stop buying more of that inventory because you're ready to stop selling it. Once you start liquidating it, what ends up happening is you're going to recognize a revenue amount, which will be here, but then your cost of goods sold amount is going to be very low relative to current prices. And the reason that is because these old inventory layers have never been expensed, and they may be at a very low cost per unit. And if that's the case, that's going to end up giving you a low cost of goods sold, which means you will get a high gross profit, right? So when that happens, we need to disclose that information. It's not a it's not a desirable effect, because what we'll have is we'll have inflated profits because we are expensing old layers that are being liquidated. So there are some things we can do to minimize these LIFO liquidation issues. One of the things we could do is to carry limited inventory, such as under a just-in-time environment. Okay, so we just buy enough to finish what we have, to sell what we have, and that's it. And if you do a just-in-time environment, well, you're going to be expensing these as you go. But normally companies will have inventory layers just to be ready for any uptick in sales, right? If that's the case, this first layer will never be expensed unless you start liquidating the item. Okay, another thing that can be done to minimize this effect that arises from liquidating LIFO layers is to use LIFO pools. And what that means is you group different inventory items into one pool, so that if at any point in time you liquidate one of those inventory items, the effect of that liquidation issue is averaged out over the other inventory items in that pool. And that could be a solution, but sometimes that's a little bit difficult because you're going to have to continuously redefine those pools, that grouping of inventory items. So given that the use of LIFO this is like a Halloween accounting video. My apologies. I could have recorded this, re-recorded this, but I'm so far into it that I said let me just keep it as such. But here's the thing. Traditional LIFO can give us these issues, right? Related to LIFO liquidation. Well, the dollar value LIFO method is an approach that we can use that is GAAP compliant, that helps us mitigate or minimize the effect of these issues. Okay, it makes it so much easier for us to quantify or group pools, because now we're not tracking units with dollar value LIFO, so we don't have to worry about the units themselves. We track bulks of dollars. And I know it seems very conceptual at this point, and that's why I'm going to do a separate video where I illustrate dollar value LIFO in detail. So the idea is this, that by using dollar value LIFO, it simplifies the accounting for us. It's still a form of LIFO, but by using dollar amounts instead of quantities, we're able to mitigate these effects, these negative effects that arise sometimes from LIFO. All right, so this concludes the video on the introduction on inventory cost flow methods. And if you want to see the video on how to account for dollar value LIFO, that'll be on a separate recording.